Okay. Morning.
Hey Gav, how you going?
Wow, what a strong couple of days in the market.
Yeah, record high right now, and obviously I think it was a record high close yesterday, and if we continue, we'll have another record high close today.
Yeah, it's looking that way. It was a bit surprising. I mean, the results out of America's economy was strong, which was going to push back interest rates, but they still charged ahead. So, yep, came to play.
Yeah, we also saw a little bit of creeping up in our unemployment yesterday, which I think will bring forward our next rate cut. I know everyone expected one this month, but I think the next meeting you'd have to assume there's one now with that slight increase in unemployment.
Yeah, yeah, I'd agree with that. That's for sure.
Right, so we thought we'd spend this meeting just going over some past results. Yeah, we're about to head into reporting season, so it's probably a good time to look at how we've been going with our tips on the channel, and maybe talk about some of the different strategies, when and why we might use them, because we've probably got a few good opportunities coming up.
Yeah, I agree. So I've been through and put together every single trade that we have recommended over the last.
Yep,
We started this in November last year, H, so we've been going
we did. Yes,
for
yeah,
So I won't go through the detail, but I'll just show some trends. Effectively, they're a combination of we either did buy rights, we sold puts, or we sold calls. So all
yep,
the green trades there are where we've sold a put and we've got the full, it's expired worthless, so that you've got a full credit. The yellow trades are where might have been a buy right, where we bought the stock and then sold a call straight away. And I'll talk through an example of that. And
yep.
overall, you can see in the green there, pretty amazing result, really, in terms of bringing in additional income. One other theme worth pointing out there is that there's a number of stocks there where we've recommended them every couple of months, we recommend the same stock. So I'll give an
Yes.
example here of where a client's actually had Fortescue. He's kept selling the calls and done very well out of it. He's kept hung onto the stock, and same with Qantas. It's popped up again. I'm going to recommend it again today. So you can see every couple of months, if you've held the stock, you can continue to do the same trade and continue to bring in income as well.
Yeah,
Now,
very good, mate. Very good. And you can see that one red trade there. That
yeah,
was that XJO put I recommended people buy on the basis I thought the market was overpriced. Well, I've certainly got that wrong over the last couple of weeks as we take out another record high today, as we spoke about. So,
yeah.
but sometimes it doesn't hurt, to buy some put protection in the market. So, not always a terrible solution or situation to have that position in place for a bit of downside protection.
Look, if I remember rightly, the market was very hot at the time. It ran up really fast. I think it was, it's prudent to buy a bit of downside protection. And if the market had
Yeah.
fallen, you could have slept very easily with that. And if you look at it in the scheme of things compared to how the rest of the trading's gone, it really pales into insignificance in that sort of over the 6 months.
Yeah, very true. Very true.
Yeah, look,
All
I'll
right, well,
just
let's get
bring
into
up.
your first Fortescue trade, was it?
Yeah, look, I'll just bring up this example. We did a buy right here where the client bought the Fortescue shares and we sold calls straight away. They weren't exercised. So we've hung on to the shares. We've managed to continue every month to sell calls again. Then we collected a dividend. We did what's called a repair trade there once. You can see where we actually spent $5 in total, which it was very close to evens. It just didn't
Yep.
quite add up. And this was on 6,000 shares. The next month it worked out, so they got a good premium there. Then we did another roll for not much money that seventh month, but this month we've just done it again, and that was back in I think it was about $1,500 we managed to do it for. So you can see there that
Okay.
month's brought in an additional $16,000 on around that $100,000 exposure, just with options and one dividend. So you can see how you can really make the dividends work. If you do end up buying them or you do end up getting exercise, you can see how you can really make those things work for you.
Yes, some good numbers there. And as you've rolled forward the different months you've had to roll the position, it's just kept that income turning over. So you're almost getting a little dividend every month out of the stock.
That's exactly the way the client's looking at it. And, they originally, the plan was to make money on the dividends, but they're reinvesting the dividends and just taking the options income.
Perfect, mate. Excellent. And it's been very successful. Fortescue's a great stock for this because it does have that degree of volatility for a 15, 16, $17 stock, sort of where it moves between. Quite a bit of volatility around that.
It's been really successful for the clients that took that idea up. I'll just go to the next,
Yeah.
which is a little bit different. This was one of yours. Do you want me you can talk through this one?
Yeah, I'll go through it. So this was Woolies, and we sort of looked at it late last year. Was really trading at a bit of a discount after I think there was just concerns over some of their costings for updating supermarket systems and distribution centres, and the market just took a real negative view. Grocery businesses are pretty simple. People are going to continue to need groceries, so we took the view that the stock would find some support and wrote puts, and we end up reasonably deep in the money where we had to actually buy the stock, which wasn't a terrible thing. We'd picked up a good bit of premium, and just after we'd bought the stock, there was a bit of an announcement from Woolies. It was actually over, I think, an ACCC ruling regarding competition in the supermarket space. The stock jumped back up to, I think, close to $30, maybe $30.50. We went and sold the call options there, and then eventually got exercised. So we ended up getting in and out of the stock for a pretty good profit, and picked up premium both sides with our sold puts, and then obviously that written call premium. So worked out as about a 5% return on that one, which is pretty attractive.
Yeah, over a couple of months, you can really see how it's worked through. It's a good example of what can happen quickly and how you can get those returns quickly.
I think, Gav, it also highlights that when we're looking at these particular stocks, it's really key for us to look at stocks that we really like the investment case behind them. We're not just selling puts on any stock. We're really looking at the investment case of why we'd be happy to own that particular stock. And so if we do get the stock, we're not in a rush to sell it back out. We could hold it and wait for it to improve in price, or for an announcement or the next dividend to come out, and then look to write some calls. So there's an investment case behind each stock we look at.
That's so important when you look back at this. All those stocks have been stocks that we're happy to hold for the longer term if we had to. They all pay good dividends. They're good companies. They're all quality there. So yeah,
Yeah.
very important.
Yeah,
Just
excellent.
one quick idea I had, H, and it might even be worth talking about how you could minimize risk with other ways around this. Qantas is up around its 12-month highs again. We've recommended this trade a few times over the last 12 months. You could see, early in the 12 months, it was trading around $4. It's up around 10 now. Now, I've had a couple of clients do over 100% on the capital gain on this one. They've actually sold it, or they're selling calls like this recommendation. So you can sell the August funny strike, this one, 11.39. You get 20 cents on 10,000 shares, which is $2,000. So it looks like another one worth considering if you own the Qantas shares.
Yeah, definitely. Probably a good little income strategy there.
Yeah.
Airlines aren't renowned for being the best dividend payers, so
No,
picking up that extra bit of premium from the option side would be a good reason to remain in Qantas, or to hold Qantas shares anyway. So,
for sure. All
mate, I
right.
thought we'd take on a little bit of a look today at some of the strategies we run, as to why and how people that are just getting into the option market may be able to use those strategies, or look at ways to minimize the risk of some of those strategies. So I thought I'd just sort of go over most of the strategies. When we're selling puts, we're looking at around about $100,000 of stock exposure. Now, that may not suit everybody to take on that much exposure to a particular stock. Obviously, in our case, we're saying we're happy to buy the shares. So, taking on that exposure is fine. But if you were more looking from a trading view, there's ways we can take on the same sort of idea, but not take on quite as much risk. So if we run one of the examples we've looked at recently, I think we looked at James Hardie, was one of the ones we suggested the other day. We were selling some puts there. I think we looked at selling 30 put contracts at $40. Okay, that's $120,000 worth of exposure. Now, if you didn't feel comfortable with that much exposure, you could look at buying a put at a lower strike than the one we're selling. So if we sold, as I said, 30 of the $40 puts, maybe buying 30 of the $37 puts to cap our risk. So what that basically does, it means we've got risk from $40 down to 37, and then we have no further risk below that level if the stock was to fall heavily. So we've taken a trade that would have had $120,000 risk, and set a $3 per for every 10 contracts, so for every 1,000 shares. So we've set a $9,000 risk to that position. Obviously, we won't receive quite as much premium as if we just did the naked trade, selling the 30, $40 puts on their own, but we've capped our risk. And it's something for many clients that are just starting out, may not have as much capital as you to have that $100,000. They can take on a smaller exposure, running the same ideas we're running, just have that less risk component to the transaction.
That makes so much sense, H. What I might do for the next video we do is I'll just write that up as an example. We can show how to work it through on the screen, and
Yeah.
look at how do you effectively, you're getting exposure there of what is it, a about $100,000 exposure, and you're managing risk for about for 50,000. Sounds like what you're trying to do there.
Yeah, basically we're definitely reducing what that overall risk would be. So a good sort of strategy. And I think also next time we meet, we might also discuss what strikes we would pick and why we're picking the strikes when we are looking at some of these transactions, how we're coming up with what we think is the appropriate strike price to enter into the trade at.
Sounds like a conversation on Delta. Look forward to it.
Yeah, excellent. Well, mate, let's hope this market holds up and we get another record close, and we'll move into reporting season in about a week's time.
Sounds good. Talk to you again soon. See ya.
Thanks, mate. See you, mate.